Having focused pretty heavily on market commentary the last few weeks, I thought I'd actually get back into a little more educational type of content. I know that a lot of my videos have focused on equity markets. Things like crypto, tech specifically, but also more economic related things. Housing market, manufacturing indexes, but I haven't really discussed treasuries or the bond markets as much as I probably should have. And that really is a shame, because treasuries are actually some of my favorite economic indicators. Maybe not investments, but very, very reliable economic indicators. Now, what do I mean by that? See, back in March, I actually wrote an article for Investment U on tech stocks rebounding because treasury yields and the performance of tech stocks is actually very correlated. Because treasuries are a very safe investment, they're backed by the US government, whereas tech stocks are generally the most risky investment. And in my article, which you can find here, I actually talked about how I thought things weren't going to get better because of a potential doubling in the price of oil, crude oil, over a 12-month span, and a potential inversion on the yield curves. Both of those things happened after I published that article. And the yield curve is actually one of the more interesting ones. See, when a yield curve inverts, it means that the interest rate on a shorter term yield is higher than a longer term. Now, what does that mean? That means that investors are pricing in more risk in the short term than they are the long term. And that's backwards because, generally speaking, if you have your money sunk into a 10-year yield, you are supposed to be assuming more risk than a 1-year yield. You are more liable to interest rate hikes, inflation, whatever it is. So if a long-term maturity is yielding a lower return than a short-term maturity, that shows that people are more concerned about the short term, not the long term. Everyone's favorite yield curve inversion is the 2-year on the 10-year. And as of right now, the 2-year is above the 10-year. But so is the 3-year, the 5-year, and the 7-year. Basically, everything is above the 10-year right now. And that's not a good thing, because the 2-year inverting on the 10-year yield over the last 55 or so years has only yielded one false positive in terms of a recession incoming. And I don't even really call it a false positive. That happened in 1998, after the Russian financial crisis, which I've talked about a bit. And that's only a false positive because it inverted again in 2000, and then the market crashed. On average, for the last 6 recessions, recession has occurred between 6 months and roughly 24 months after the yield curve inverted. The yield curve inverted back in April, so we're 3 months in. So if we aren't already in a recession, there's a reason why people keep talking about 2023 as a very good landing spot for a recession.